support that we are providing to that agency. With that, I'm happy to hand it over to the city's finance director, Susie Haugen.
Okay, thank you very much. And I will share my screen. And maybe you can let me know. It looks like that's working.
Looks good.
So off we go.
Yep, looks good.
Oh, it's here we go. My computer was trying to catch up with everything. So thank you very much. And as Council President described, we're going to go over the city's reserve funds. I'm going to concentrate on our larger reserve funds, and the committee has been provided with a packet of all the reserves. And so if there's any follow-up questions on the smaller funds, then we can certainly address those. I'm also going to be going over the city's investments and supports in the PFD. So let's just start right away with CIP 1. This reserve fund was established in 2016 to accumulate resources to fund major repairs, renovations, or replacements of existing city facilities. The projects in the cash flow were identified in the Ming facility needs study as critical deficiencies, and they have been prioritized by facility staff. All projects will come before council for funding approval via plans and systems ordinances. Some major projects that are currently planned for the next few years include several core building replacements for the EMB, such as an HVAC system, roof, and elevators. We have a remodel of a couple floors of the municipal building to consolidate staffing from the service center into the downtown. We have a parks administration building renovation. We have work to be done at the South Precinct. We also have HVAC and window replacements at the police headquarters, and some exterior masonry renovation at the fire training building at 2801 Oaks. And of course, these are not all the projects on the list. These are just some of the bigger ones. Initially, we opened the fund with a planned contribution of $1 million per year. However, after the completion of the Ming study, the annual contribution target was raised to $3 million. But as you can see from the cash flow, the fund goes negative in 2027 based on the projects that are in the cash flow, and that means that each year the facilities team will need to reassess and prioritize projects to keep spending within available resources.
Question for you.
Mm-hmm.
The continuing decline in our fund balance, that includes the $3 million contribution.
Yes, it does.
Okay, thanks.
Yes. Next up is CIP 2, which is funded by REIT 1, which can be used for capital expenditures identified in the city's comprehensive plan. Currently, CIP 2 is funding the debt service on the Angel of the Winds Arena. And as you can see in the chart, REIT is highly sensitive to economic cycles. The 2012 bonds, which refinanced the original conference center debt, will be ramping down over the next couple of years with the last payment in 2026. This will free up some capacity that we have not seen for many, many years in CIP2 to fund a bond issue to cover the unfunded portion of the Edgewater Bridge, the Eclipse Mill Park, which will be mostly covered by a LIFT grant, and the unfunded portion of the EMB core building replacements and remodel. We estimate that those bonds will be issued in late 2024. So more to come on that as we firm up some numbers in the coming months.
So question I have about your forecasting, you're basically expecting that the revenue from REIT is going to flatten out?
Yes, actually we are experiencing an extraordinary year. We're looking at perhaps getting as much as $4 million in CIP2. which would be our highest year ever. But as interest rates rise and we expect real estate transactions to slow down a bit. So we are forecasting a return to a more, somewhere more around the $3 million level, which is where we were in these years during here going forward, with a very small annual increase, recognizing that property values go up and this tax is based on the sale prices.
I just wanted to reinforce that, the idea that it, I think at a minimum, it's going to level off.
Yeah.
My other day job has a unique perspective on that, as you know. So
yes,
we process REITs for the county in my office. So
yes.
yeah, so I think that prediction is, or I should say that forecast is very sound.
Yeah. Thank you. Okay. And CIP 3 is funded by REIT 2, which is the more restrictive of the REIT revenues. It can be used to fund park, streets, and actually water, storm, or sewer system capital improvements. As the other half of our REIT income, it's subject to the same volatility as REIT 1. Historically, REIT 2 has been allocated between parks and streets with a ratio roughly 62% to parks and 38% to streets. Although there's no formal allocation on that, it's based on the projects that have been funded. We do rely on REIT to pay for new park construction, playground equipment replacements, restroom renovations, and a variety of other park investments. On the street side, REIT 2 funds a portion of the annual street overlay program and the debt service on the LED street light replacements. The evolution of how park and street projects make it into this cash flow begins with the foundation of the park strategic plan and transportation improvement plan, both of which are approved by council. The departments work within that framework of those plans to prioritize need based on the condition of the park amenities and street infrastructure. And ultimately, each project is brought forward to council for funding approval via plans and systems ordinances. So council really has oversight from the very beginning and at the point when the budget is appropriated. The reason why you see the fund balance bumping up in 26 and 27 is because most of the parks projects are identified in the 3-year time frame. So moving forward, you'll see projects filling up those later years as well. CIP 4 is funded by contributions from the general fund and lease payments from Snow 911 and the Cope Gillette Theater. Most recently, this fund paid for a portion of the downtown streetscape project and will pass through funds for the Eclipse Mill project and Riverfront Trail projects. Historically, examples of cash funded projects include we built the animal shelter with this fund, the Cope Gillette Theater renovations, the South Precinct reno, municipal court construction, the South Library expansion, and of course, many, many more.
So just a quick comment on this. So I see here a drop in the forecast in revenue, or I should say in the balance. Is that due to Snow 911 is going to be leaving the facility?
Well, this has to do with projects being funded.
The expenditure side?
Yeah.
Okay, because my understanding that Snow 911 is also going to leave.
Yes, and that is something we just heard about. We don't have that built into the forecast yet. Okay. We're kind of waiting to see exactly when they think that they're going to move out. I know that they have a building that they're interested in, but of course it takes time for renovations and the like getting moved. And so once that happens, we will be removing that from the cash flow. And that's about $180,000 a year.
So most of this revenue is coming from the general fund,
Most of the revenue in this fund has come from the general fund.
Yeah, okay.
Yeah,
For sure.
and in the old days that I've been here that long, often at the year end, the annual surplus from operations would be split between this and other uses. And so a portion of that would be going into this fund. And while we haven't been doing that because we've had so many other needs, this fund has been in the past really important for strategic opportunities that have come along for the city, and just to have, you know, a capital improvement program that can be used for something that comes along that you wouldn't anticipate. If a piece of property comes for sale that becomes strategic, or just other projects that are strategic. We paid for the municipal court building out of this program, and just various other things. So just point out the value to that.
Yeah, I would say that if there was any type of CIP one, obviously needs some long-term new sources too. Yeah. Thank you.
And next we have the vehicle and equipment reserve, which accumulates funding for general government replacements. Contributions come from the general fund and vary based on budget priorities. Our long-term strategy is to maintain level contributions with a low growth rate over time to avoid large hits on the budget when replacements become due for high-cost replacements such as fire trucks or heavy equipment. The table at the bottom summarizes certain planned purchases between this year and 2027. Under the current funding plan, there will be sufficient resources in the fund to complete these purchases. We have a self-insurance reserve fund, and there are 5 sub-funds in this reserve. We have a sub-fund for property insurance, unemployment, Calmback Dam, workers' compensation, and tort claims. In the tort claims sub-fund, the target minimum fund balance is $4 million. We have had a few large claims that have consumed some of the fund balance recently, but we expect to be back on target by 2025. And for workers' compensation, are
you going to skip the Calmback Dam one, Susie?
Yes. But we can talk about it briefly. I don't.
Yeah, what's that for?
Sure. Well, we have the City of Everett shares liability for the Calmback Dam with the PUD, and I think it's the PUD. Ran, is it the PUD or Snohomish County? I want to say it's the PUD. Yeah, well, I'll get back to you on that.
Yeah, Susie, it's David. It's the PUD.
It's the PUD. Thank you, David.
It was the PUD, but I thought we got out of that dam obligation.
Not to my knowledge. And actually, this is although the self-insurance reserve fund is more of a citywide reserve issue as opposed to most of the general government ones that we've been talking about. And actually the Calmback Dam is tied to utilities and not the general government. So we do have a fund balance in there that would allow us to meet I believe it's our deductible on our liability for the dam, but that's really more of a utilities issue.
Okay, so what dam did we co-own with the PUD that we got? Was there another dam? We went through the process of removing ourselves from the federal license for the dam up at Spada, or that comes out of Spada.
That's the Jackson Hydroelectric Project, and we're not entirely.
Thank you.
We did disentangle ourselves somewhat, but we're not entirely removed from that.
Okay, and this is the other dam that generates power on the spillway. Is that correct?
I believe so, although I'd have to look back at that. But
okay, I may need a refresher on this. I'll just put a bookmark on that.
Sure.
to remind myself what dam that is. So we have a liability there that we are insured against.
And that we have a reserve too.
It looks like
Okay.
we have 3.5 million in their
Mhm.
reserve.
Yeah.
And it looks like I don't see a lot of expenditures there. I see just interest increase.
Yeah, there's never
Yeah.
been, to my knowledge, and I've been doing this a long time, we've never had an expenditure out of this reserve. It's merely a backstop against the liability. It's utilities money, and it does earn interest. So,
Okay. All right. Because I don't see a minimum ending balance there.
yeah, there is
Okay.
not.
Well,
All right. Thank
it's
you.
like it was started with $3 million and then interest bearing just kept adding up to it. So.
So in terms of workers' comp, we have experienced a very high level of claims and a couple of settlements. Fortunately, however, we've had sufficient fund balance to cover it this far. And quite frankly, council can expect to see a budget amendment request at the end of the year to increase the appropriation to cover this exceptional activity this year.
And were the claims just normal claims, or were they related to COVID or anything? What are we seeing?
I think you're seeing a variety of things. We've had some larger claims which council has approved recently. And also there's been claims from COVID and just a real variety, but
Okay.
it has been exceptional.
Yeah, those bigger ones are probably out of the usual for us.
Yes, certainly hope so.
Okay.
So I have a question about that. When you said you got a fund balance here in the tort claims of 4 million, and then we have a minimum of 1.5 million in the workman's comp. We don't have an expenditure. It's probably in the other part of the budget then.
Yeah, I've tried to keep the slides simple.
Okay.
In your cash flow, you have 4 sheets, one for each of the reserves, and you should be seeing claims and both medical and regular claims, plus the administrative costs associated with the workers' comp. But claims have been extraordinarily high.
Yeah. Okay. Yeah, I have them here. Thank you.
Okay. Next, we have the left one police pension fund. And this fund accumulates assets to pay pension and other post-employment benefits for plan members, often called OPEB. And those are actually medical benefits. The plan has been closed to new members since 1977, and the city has no active Left One employees. Although the city is only required to pay current expenses, we have been setting aside funds in excess of the annual costs to build towards a point where the program can run off of investments with no further contributions being required. And the current full funding target date is 2030. If the city were to stop contributing to the fund, the accumulated resources would be depleted sometime in 2035, according to the current actuarial study.
So quick question about this fund and the both, I guess, the fire one too. What's the actuary assumption on interest accumulation?
Right now, it's at 4%.
Okay.
And
Over how long of a period? Sorry.
Well, it's over the life of the
Okay.
considered to be the liability, so out
Thank
through 2060.
Thank you.
I think. So the fire pension fund obviously is similar in structure and plan to the Left One Police Pension Fund. And this plan has also been closed to new members since 1977, and the city has no active Left One fire employees. The funding plan for Left One is the same. Left One Fire is the same as it is for Left One Police. And like the Left One Police Pension Fund, the Left One Fire accumulated resources would be depleted sometime in 2035 if no further contributions were to be made. And that concludes the reserves that I brought for review. And unless there are other questions or discussion you would like on our reserve funds, we can move on to the PFD.
Any questions,
No,
Councilmember
thank you.
Schwab?
No, we're good. Thank you very much. The report is good.
Thank you. Good information, Susie. I think we're ready to move on.
Okay, so the next couple of slides provide information regarding the city's commitments to the Angel of the Winds Arena, and the PFD also provides the PFD's capital plan. So between 2001 and 2003, the city purchased the land that is underneath the arena, and we also funded the construction of the conference center and provided additional funding for upgrades to the arena's facade. In 2014, we took on 27.6 million of the PFD's outstanding debt and also loaned them $650,000 for a new scoreboard. In terms of annual support, we pay an average of about $1 million in debt service for the conference center and the facade upgrade, and about 1.9 million for the land acquisition and debt assumption. And all of those payments come out of CIP2. In addition, we have committed to provide the PFD with $500,000 per year from the general fund and $100,000 from lodging taxes through the life of its remaining debt, which matures in 2041, at which point the city will take ownership of the facility.
I'm sorry, what year was that? They take ownership?
2041.
2041. So question on the debt, did we refinance those bonds at all?
We've refinanced them a few times over the years. We started out with variable rate demand bonds back in 2001 for the land acquisition and the facade, or the land acquisition, and the conference center we originally financed in 2003 with fixed rate debt. Then we refinanced the variable rate bonds with floating rate bonds, a little bit different structure, but same concept. And then in 2012, we refinanced the conference center to fixed rate debt, more fixed rate debt. And we still have the same 2012 issue, but in 2014, we refinanced the variable rate demand bonds into fixed rate bonds. The market for variable rate bonds kind of dried up at that point, and our outstanding debt just wasn't enough to, in 2019, we refinanced the floating rate bonds that we had outstanding to fixed rate because there was not enough of a market to issue floating rate debt on the outstanding bonds that we had left. And so now we have the 2012 issue, which is going to mature in 2026, fully mature, as I mentioned earlier, and then the 2019 bonds extend through the year 2034. So we did refinance the last refinance, which was in 2019. We're at very favorable fixed rates, and based on the projections that actually provided about an $880,000 present value savings over what we were seeing in the floating rate.
Good job. Thank you.
Yeah, and it seems really smart to have done that now, for sure.
Yes. Oh, yeah.
Absolutely. And the rates on our 2012 are so low that it didn't, because they were done during the Great Recession, it didn't make sense to refinance when they became callable. The rates are just so terribly low, or wonderfully low, let's say it that way. So a little bit about the Public Facilities District Capital Plan. The PFD has between about $1 million and $3 million in planned investments over the next few years. And projects include a variety of replacements and improvements to the core building facilities and technology. The PFD also brought in Maine for a facilities assessment, which they used in conjunction with their own building engineers' estimates to develop this project list. And I'm afraid I don't have terribly in-depth knowledge or understanding of these projects. However, if there is an interest, I can always ask Corey Margolis, who is the manager of the facility, to present at a coming committee meeting if there's interest.
Susie, these projects all look great, but when they had that, did we get a copy of that assessment?
Yes. And I can provide you with another one if you like.
That would be great, just because I want to see. So when you look at that, this is what they're planning on spending, but what's the delta between that and probably what should be spent? Because there's usually this growing deferred, maintenance problem on these big buildings like this. What is the liability that the city is being set up to assume at some point?
Well, my understanding from attending their budget committee meetings is that they have been doing projects of maintaining the facility. And especially in the next few years, they have some more significant projects in place, like replacing an HVAC and the ice plant chiller. Those I think could be considered fairly major core building maintenance replacements. So I think if we want to really dive into the status of the building, the state of the building, it might be a good idea to bring Corey in so that he could talk about it more knowledgeably than I can. Because I'm not aware that there are huge outstanding issues with the structure.
Yeah, since we are going to inherit the building at some point, it seems like we should have a little bit more visibility around what they are and aren't able to fund out of their operations. Because I know that's been an issue in the past. That scoreboard thing, when we had to help them pay for that because they just didn't have the wherewithal to do it. And that is not as fundamental as like tuck pointing the brick or something that would really create a, structural, would affect the structural integrity of the building.
Yeah, as far as operationally, they are doing better this year than they did last year, and certainly better than 2020 when they were closed for COVID. Their income from operations, so they look at their income in two sections. They have the income from operating the facility, and then they have what they consider to be the PFD's income, which is the sales tax from the state, all the support from the city of Everett. They also get distributions from the county, from their portion of the sales tax credit, and also they get some, I think they get some LTAC money or lodging tax money from the county. So they have a variety of other sources of income for the PFD, but just even operationally, through May, they were doing about 131,000 better than they did in 2021. But the PFD portion, because sales tax has been so strong, as you know, from our own sales tax income, they're 343,000 over budget from
their portion of sales tax.
Portion of sales tax. And so they're actually over and above, they have required debt service reserve for the bonds that they retained. But it looks like they're projecting to end the year with about 2.5 million in cash, which would be used then, of course, to fund some of these projects. So the good news is that they are doing better. And possibly even better than, before COVID. So that's the really good news. But I can certainly, dig in and see if I can get some more details from Corey. I know some of these projects, like the LED ribbon, they've been discussing perhaps getting a grant from the county to help pay for that. And so they are working all the time. They're working it all the time to get money where they can. They were unfortunately turned down for some federal money for closed facilities. And there was never really even any good explanation for that, because I think the Showware Center got some money, and that was a big disappointment. But they work really hard, I would say, at trying to tap whatever opportunities there are out there to cover some of this stuff.
Okay, good. Well, that's good. I like to see that they're doing this kind of spending, because in the past, I don't think they were even spending nearly this much on capital expenses.
I think that the main report really helped kind of galvanize this, and also the requirements in our contingent loan agreement required this work. We have elements in there for that, for just this purpose.
Yeah, I remember being part of that.
Definitely. So I think that this is all really important stuff. But if you want to understand anything more in depth than sort of the big high level look that I've given you today, I'm certainly happy to round up some more information. Usually when I have facilities issues coming in, I bring in a ringer, right? I'll bring in
exactly. If you could just send a copy of that report back over, I will refresh my mind. Maybe I didn't look at it, or it's been a while since I've looked at it. So just to kind of get a sense. And then if I have any questions, I'll let you know.
That sounds great.
And so I had a couple of questions about this, but go ahead. This isn't the only debt service. There's other debt service that they owe. Are we the main issuers, or the flow? Are we of the debt service, and are we their treasurer?
No, we're not their treasurer. And they use the LGIP, so they keep their funds in there. And then of course they have an operating bank account. And Don, what was your first question?
Was their debt service?
Okay. Yes, we actually hold the majority of the debt on there. They have, I think it's between 18 and 19 million in revenue bonds that are guaranteed ultimately by the city through our contingent loan agreement, but they're revenue bonds based on their sales tax income.
Okay, so if they need to, is there a contractual agreement that if they want to issue more debt that we have to approve it?
Yes.
Okay.
Absolutely.
Thank you.
And I believe that concludes the information that I brought this evening.
Well, thank you, Susie. And so just for the big picture, this information is being provided so that we can kind of understand what our minimum target or minimum ending balances are for these reserves and where we're at against those. And it looks like for the most part, we're in great shape.
We are in good shape in some of them. I would say CIP1 obviously is not in great shape.
Right.
And we could always use more in CIP3. but that of course is dependent upon REIT 2 and but
And we flex our projects really on, I mean, we could use more in it because we'd like to spend more on parks and transportation improvements, but we can control the spending a little bit more on that versus, for example, tort liability, where it just happens.
yes, but I would say the tort fund, workers' comp, those, all the self-insured reserves, those are in decent shape. And
that motor vehicle and equipment reserve, I mean, it looks like we've been overfunded relative to our minimum, our target. Is that, can you just speak to that a little bit?
So, you know, the thing with the motor vehicle reserve is that we do have to build it up higher towards the time when we're going to be buying all these fire trucks, and certain heavy equipment is very expensive, and we can't really just keep it at, you know, $2.5 million even going forward, because if we did that, if we wanted to buy a fire truck and then even like one ladder truck is over $2 million, and that would deplete the reserve. So we do have to scale up the fund balance into so that we can have sufficient resources to make those purchases. And we just happen to be at a point where I think you recall we've put a couple of purchase agreement contracts for a new ladder truck, which is over $2 million. And then we've got two of the, I think they call them pumper trucks, and those are about $1 million each. So there's $4 million right there, just right off the top. And fortunately, there's 2-year builds on those. We won't be taking paying the full amount until 2024. But they represent a big hit that you need to save up for. So
yeah, I just have a couple more comments, if I may.
Sure.
I don't think really our capital improvement program is really that healthy. We're talking about an annual inflation rate, you know, that's skyrocketing. I guess, and if you took building materials and labor costs, it'd probably be even higher than 10%.
It's over 20 right now.
Yeah. So, and I also am concerned that even like the PFD, since that's on our list today, that if the economy changes, I think there's considerable more liability there. And I'm glad Councilmember Stonecipher brought up the maintenance of that building. Those costs are actually going to start skyrocketing too. So I don't know what the process is for, I know your annual target contribution of $3,000. I would say I'd only agree with that because we're using the money we should be putting in that fund to balance the budget. So it looks like to me about double that we should be putting into that fund.
Yeah, unfortunately, we just don't have the financial wherewithal to put as much money into CIP1 as we would choose to. Were circumstances different, but you know, if we were to choose to double the 3 million and put 6 million into CIP1, we would have to cut $3 million out of services, and we've cut back so far of late that it's a really difficult decision, and it's a crucial balancing act. So we're trying to put as much funding in there as we can and knock off the most critical issues that are, you know, plaguing our facilities. And we will be taking care of quite a few of the core problems, for example, in the municipal building, and getting some relief with some debt service that will pay off through CIP2, you know, down the road, to create a little bit of capacity there. But we, you know, we can only
do what we can. Well, and I appreciate you saying that. And I guess that comment was really more for those in our community that may be watching this either today or at some other time. If you do, we really appreciate you. for being interested in some of the grass works that's going on here in our city. And I appreciate all the work you're doing, Susie and Lori and your staff. But it's still really important to know that this is a very restrictive flow of money going into these funds. This is not ideal by any means. So thank you.
Yeah, and I think maybe the part of the, just to piggyback on that, Councilmember Schwab, is that because we are not publishing our current target for some of these funds that are critical, that, you know, maybe that could be a little misleading to people who are looking at just our materials, and having some conversations around the funding of it's mostly the CIP programs, because it appears if the current target or minimum ending balances are relatively accurate, a lot of those funds, again, the self-insurance and all those other funds that that we know we can't forego, because otherwise we would be in really hot water, seem to be in okay shape. But the other funds where we really haven't looked at, you know, done a lot of work on where we really think we should be. I mean, again, the CIP4 fund used to be, the target was to put in at least half of the operating surplus every year. I mean, that was sort of our funding policy, wasn't written in stone, but it was what we were doing. Might not have always been half, but it was sometimes, you know, up to half. Maybe it was a little bit more and less in certain years. So anyway, I just think that, you know, to your point, Councilmember Schwab, we are, in some ways, we're showing a good picture on certain funds, but we're not, we haven't dealt with sort of the policy question of how should we be funding these capital reserves and the pension funds, and, you know, what do we want those funding streams to look like, so that we are getting those balances in places where they're healthy enough that we aren't building up an unfunded liability for future generations. I mean, we're not paying our portion of the cost of having fire and police service that occurred in the past. Essentially, we made commitments to people who worked in our fire and police department, and then we didn't fund it when they were working fully, and so we're funding it now that they're retired. And the idea is that when you pay it over time, that all generations are equally sharing in the burden of that, which came before them. You know, these are old liabilities, or they're based on not old liabilities, they're current liabilities, but they're really based on a service that was provided in the past. So,
well, we are today back on target for the 2030 full funding. However, as you know, with each actuarial study,
right,
we get numbers, and with the rising cost of medical care, we seem to, you know, the costs seem to go up with every
going out.
And also, you know, it is certainly without question the financially prudent to fund this liability ahead of actual costs as quickly as we can. And it is where we are, you know, current generations are paying for police and fire services that they were not here to, you know, appreciate. However, the extent that we fund these funds, try to get ahead of the annual costs, there is a cost to the current community as well, because all the money that we're sequestering in these funds and the amount that we're putting in there every year, it's definitely financially prudent, but it also comes at a cost of current services, because these are funds that we cannot put in CIP4, or we cannot put in CIP1, or we can't use for you know, some other amenity or service that our community would most likely really enjoy. So it's a very difficult question, I guess I
Mhm.
would say.
Well,
Yeah.
I think someone can make a good case that we're not putting enough dollars in the CIP funds. And I think we've had some presentations. Remind me, Sissy, who gave a presentation. Maybe it was like my first day in January in the council where we had a presentation from facilities.
Mhm.
And I don't see any of those projected needs on our budget. So for those out there, for those watching in our community, I just let you know there is a substantial justifiable need. And I think you could make a pretty good argument that if we defer maintenance of our facilities, that in the long run, it could cost more.
Mhm.
So this is a delicate balance that we're all dealing with. And so I appreciate you guys for that balance.
Yeah. Okay, any further questions or comments? All right, Susie, when is our next budget meeting scheduled? Do we have one on the books yet?
We do. It's for August
It's
17th.
the 17th.
Okay, great. So for those who are watching this meeting and for council members who will need to be there, August 17th will be our next meeting, probably at 5 p.m., same time, same place. And without any further business and no further questions or comments, we are adjourned.
Thank you.
Thank you.
Thank you.